This is Michael Fox, and this is the Prospector News Podcast. And joining me is longtime contributor and friend Chris Temple of the National Investor. Welcome aboard, Chris.
Good morning.
Good morning. So we've had inflation numbers, and I have to say I was expecting inflation to rear its ugly head upwards again, but I wasn't expecting it until the February numbers, which would have been released sometime next month, but they seem to have shown up early.
Well, they have, and a lot of us have been saying all along, you and me and others, that we were going to see a lot of these early 2023 rallies come off the boil when the reality set back in, that inflation is not going to go down in a straight line, that there is going to be a point, which we're apparently at, where it's softening stalls and leaves us still at very, very high levels. So, the story in the markets, Mike, for some time, since I think even late last year, has been that there's been this disconnect between market expectations and what the Fed has fairly consistently warned of. And almost in one fell swoop this week, we've seen some asset classes that are starting to reflect that, golly gee willikers, maybe the Fed is right after all, that they are going to raise rates 2 or 3 more times from here, that they are going to keep the federal funds rate north of 5%, perhaps well into next year. So there's not going to be any pivot come anytime in 2023, at least, all things being equal. So the currency market has started to reflect that somewhat. The dollar's correction has bottomed and reversed. Interest rates have gone back up. In fact, this week we've seen the 6-month Treasury close above 5% for the first time in 15 years. Long-term rates are still a fair bit lower than they should be, although they're playing some catch up. So, precious metals, as I predicted a few weeks back when we again got out of our trading positions in gold at exactly this latest peak, their prices are down. I don't think we revisit the lows that we saw last year, but we're still going to go down probably. It's an important chart point on gold, and I'll be giving you an article for the next Prospector News on this. You're going to want to watch 1750 to 1775 an ounce near term. I think that we're going to go down and retest that level before we're all done. So the only thing that really, or the only markets I think that really haven't reflected this reality are the stock market, which has held on to most of its gains still for this year. And also corporate debt. That's been talked about a bit more. You've still got very, very tight spreads to where, corporate debt markets don't reflect at all that we're going to have much of a recession, let alone what you usually have in a recession. And that is, an increase in defaults and bad loans and things like that. So, the macro picture is what you and I and others have warned it's going to be. This is going to be a slow, dull ache of stagflation. It's going to go on for a long time.
Yeah, I'm not in any disagreement. What I found really intriguing about the inflation numbers was there seems to be a separation between consumer goods and services. Consumer goods, the inflation rate hasn't risen quite as much as you would think, but most of the inflation that's going into the inflation number seems to be coming from services, and most disconcerting is transportation's included in that. That's skyrocketed quite dramatically again. And as you know, I'm a big watcher of cost inflation because people have to sell stuff at a profit, and if costs go up, prices have to go up.
Well, that's right. And maybe it's not going to be exactly the same picture as it was in the late 70s through the early 80s, but we do very much have a cost push inflation cycle that is underway. It is not impacting everything. You mentioned goods. For months, apparel prices have been soft. I think they're actually less now year over year. Well, why is that? It's for a lot of reasons. A lot of the stores early in 2022 stocked up a lot on different, clothing and some forms of appliances and things like that. Sales weren't what they thought. So going into the recent months, they had to start discounting these things. But, you know, even though it still hasn't kept up with the inflation rate, wage growth has been halfway decent in the recent past by the standards of the last few decades or so. And, you know, that is reflected in the services inflation. That's going to be very hard to bring down. And again, Jerome Powell, the Fed chairman, has made very plain that the central bank thinks it has more work to do precisely for that reason, that the service component of inflation pushed by higher wages and the ability for a lot of different workers to command higher wages, that has not peaked, and it may not peak anytime soon. So you've got goods, yes, because of surpluses and whatnot, where prices have softened, but that's all. And you know, last but not least, and you alluded to it with talking about transportation, we've seen the best we're going to see out of energy prices. You know, and barring the wheels coming off of global markets that sends the whole economy globally into a tailspin, the best news as far as correction in energy prices by and large is already in the rear view mirror, and we're going to start to creep up. So you know, we're going to stay it, whether, you know, we get to a 5 handle on year over year CPI or not, I don't know. But, you know, if we're going to stall here at 6% plus CPI year over year and 7% producer prices, we got that news this morning. You know, the market's still got a lot of repricing to do for what the Fed is going to do in response to this.
Yeah, definitely. And, you know, you alluded to wage inflation, and as long as the unemployment numbers remain where they are, and, you know, the job creation numbers remain where they are, people are going to be able to demand higher wages, and that's going to continue to be a cost push in all of this as well. So, yeah, I'm in agreement. I don't think the Fed's done, and I don't think they're going to be done anytime soon either.
No, they're not. And, you know, which begs the question for investors, what do you do? Because clearly we're going to see near-term corrections likely continue in at least some of the resources. I am heartened recently to see that in some areas, whether it's individual commodities like lithium, which has stayed strong as we're recording this, a lot of share prices, despite the, you know, the broader stock market and even commodity correction, you know, things like that. What do we do? I mean, are we in the right places with our money to, as we need to ride out the bumps between here and where we know inevitably a lot of these things are going to go? Or are there some sectors that are going to benefit more from all of this, from higher interest rates and so forth? So I think that there's still very fertile ground out there for investors. But as I alluded to earlier with, for example, the precious metals, and we started out, this is just the latest lesson for a lot of gold bugs out there, that you've got to understand what makes the gold sector work today in 2023, which, as you remember, when I put out a report on this late last year, it's why I entitled it, "This is not your father's gold market."
Yeah, definitely. That's actually a really good lead in, because my next question was going to be, given this environment, and it looks like the environment is changing from where it was 2 months ago, what does that do to your new FAANGs theme?
Well, the new FAANGs theme long term is still as solid as ever, and I'm, you know, putting out a lot of stuff just in the coming few days in advance of our both being at Minds and Money, where I'm going to give the opening speech, you know, the keynote speech, I guess they call it, for the conference on the new FAANGs theme. There's a host of reasons why, for all of these different things, long term, we're going to see a secular bull market for most commodities that will outperform financial assets. And in a lot of these cases, it'll be because financial assets are doing so poorly, and investors have to take commodities of almost all kinds more seriously. Where gold is concerned specifically, Mike, you got to keep in mind that investment demand for gold, and I'm not talking about people that are, I think, wisely preparing possibly for worse times, that have been buying bullion in record amounts. That is not what statistics refer to when they talk about investment demand. Nor am I discounting the fact that central banks have been buying more gold in the recent past than they have in a very, very long time. What has completely fallen away in the last year or so, but I don't think is going to stay that way, has been investment demand. When you go back, one of the things I teach in this gold issue of mine is that for a long, long time, it was a very static equation that overall gold demand every year was essentially, and I'm generalizing, 2/3 jewelry and fabrication and 1/3 investment demand. That's what you had. Okay. So what do we have these days? For a long time now, you can go back all the way really until to the wake of the 2008 financial crisis. Investment demand, and I'm talking ETFs and things like that, investors buying gold and silver, not people buying coins. Okay, there's a distinction. That ended up comprising, for more often than not, going back to 2009, that was more than half of the overall gold demand. And that has fallen away. Now, prior to, I would say, last year, it fell away because there was too much fun to be had elsewhere. The stock market was doing great. People were buying cryptocurrencies and meme stocks and real estate and everything but gold. So that's why investment demand stayed down. In 2022, when everything was getting hit, even though the gold price did well, because of the demand for coins and bars, the demand by central banks, investors still were not paying any attention because they were afraid of everything. But I think the demarcation point is coming when investors realize, and I saw a great comment online about this in just the last couple of days, that gold is really going to be on fire, and of course silver will go along with it. When investors realize that for all of its talk, there is going to be a limit, and again, we're not there yet, may not be for most of this year, but when the limit comes to what the Fed can do to fight inflation, and especially if they need to respond to a crisis someplace because of this hyper leveraged world and markets that we have, and something breaks somewhere, when that point comes, fasten your seatbelt. And that's when investors will have the light bulb go off over their head again. And that's when we will see this. And to me, it's getting to be unexplainable weakness in investment demand. That's when it's going to turn probably on a dime, just as it did at very, very late in 2008. Because for those that remember, gold dropped, by it had just touched $1,000 an ounce area again. Prior to everything crashing in 2008, it dropped to under 700 an ounce, but it was one of the first things to firm up. And in less than 3 years from that point, the gold price tripled. And the same set of circumstances that caused that to happen are going to develop again. It's just going to take a little bit more patience.
Yeah, I agree. And I think we'll know that we're in a proper bull market for both gold and silver when the mining stocks take hold as well. There's been a disconnect between the gold and the silver price and the mining stocks. The mining stocks have been lagging well behind.
More than any time did any of us remember. And again, that underscores the point that for all of the talk about central banks buying, central banks aren't buying junior mining stocks. They're buying physical gold. And the problem is there hasn't been enough other people buying any of these stocks. But when you look at the recent news, for instance, of Newmont wanting to bring Newcrest, which once upon a time was sort of part of Newmont, back into the fold, you look at a couple of the other deals in the gold space, the people that are closest to the industry that have these big companies know that this is a time to be buying. So, how long it takes all of the 99.8% of individual investors who aren't automatically gold bugs and aren't already fully invested, how long it takes all the rest of them to wake up remains to be seen, but I would put it in months rather than years.
Yeah, I think there's going to be some shock somewhere to the system, like you say, that's going to, just be like an alarm clock just ringing off the wall. It'd be almost cartoonish, where the alarm clock vibrates on the nightstand beside the wolf in the bed. It's going to be like that when it does happen. So,
yeah.
Energy. we alluded to, how the lithium stocks have been holding up well in comparison to the overall market. As we start to see energy inflation continue on, is that going to create headwinds, or are we going to continue to see, gains in oil, gas, lithium, uranium, and those typical energy stocks?
I think we're going to see that continue, Mike, by and large. You're going to see corrections from time to time, in 2022 more acutely as this overall stock market was weakening. It did result in some of that phenomenon of throwing babies out with bathwater. So some good companies and good sectors got sold off by investors who were trying to just get their wits about them and figure out, okay, how bad is this going to get? I do believe going forward that we're going to see investors, generally speaking, distinguish even more between the types of companies that are, especially those that have had big rebounds this year. I mean, you look at some of the Cathie Wood stocks, the overvalued big tech stocks and stuff like that. There's been monster rallies in these things because you got a lot of liquidity out there and still a lot of traders with more money than brains who got out in front of a Fed pivot that, again, as we said at the outset, isn't coming anytime soon. So those things will be sold off. And I think more and more you're going to see people that are going to take their positions once the reality registers a bit more that, this is nothing to panic over. But yes, we are still in a secular bear market for stocks. Yes, we are going to have stagflation for many years to come, but there's still a lot of liquidity. Life still goes on. The question is, where is the money and activity going to go? Where are there shortages of things? And that word shortages, I mean, I listened months ago and I refer to this in my new FAANGs presentation regularly. Jeff Curry, who is the head commodity strategist at Goldman Sachs, has been spot on this before most people were, and pointing out that the strength of these commodity moves and then ultimately of a lot of the stocks that invest in these commodities, unlike in the past, is really not that dependent on the health of the overall economy. And assuming it just doesn't go completely into a depression. And the reason is shortages all across the board, whether it's oil and gas, whether it's coal, whether it's uranium, whether it's lithium, whether it's nickel, whether it's copper. I don't care what you're talking about. The story with just about everything is years of underdevelopment, years of underinvestment, to the point where for a global economy that is still growing its populations, GDPs are still growing, at least modestly in most places. All of that stuff requires ever more of all of these different energy and commodity inputs that aren't there. And the situation, as you and I have talked about many a time, is made worse by just these boneheaded moves by governments, especially in the US, which is one of the worst. The EU is horrid when it comes to this. Canada is less bad, I think, in relative terms. But when there's still so many straitjackets on the types of companies and industries that will help to solve this problem, you're just guaranteeing that prices are going to stay high for a long time to come. And no matter what happens to the broad markets, those are still investable themes.
I agree, and I think they're going to become more investable. As we know, at the last COPE meeting, they actually had reality slap them in the face, and they realized, what I've been saying for years, they can't get from A to B in the timeline that they're wanting to do it, because the technology is just, and the resources aren't there. They can't do that. And I often wonder now out loud, are we going to see a resurgence in investment in the oil sector because we can't get from A to B without there being some form of a bridge, and that bridge is what's already there, which is, the oil markets. My biggest winner in 2022 was Canadian Natural Resources, which is an oil sands company.
Yep.
I'm way up. I still got, runway before we hit the target price, because oil has fallen off in the last little bit, but it's about to resurge. But I'm going to draw an analogy between the oil of today and cigarettes in the 1980s. In 1980s, smoking became like the worst thing you could possibly do. And, governments banned advertising, they banned sponsorship, they did other things to inhibit the tobacco industry. The industry said, okay, I guess we're going to be sunsetted here. So we're going to reward our shareholders with every last dollar we possibly can. And there were outsized dividends being paid, share buybacks, as the tobacco industry slowly rode off into the sunset. Not that they're gone, but you know what I'm saying.
Yeah, great analogy.
And I'm seeing the same thing happening in oil, where there's a whole bunch of share buybacks. I'm embarrassed at the dividend rate I'm getting from Canadian Natural Resources, but they don't, they're not exploring for anything new because they've been told that they're a sunset industry. So is that going to change in your mind, or are we going to continue to see this underinvestment in that sector?
Well, we're going to continue to see underinvestment because even though in the case, I'll stick to the U.S. for the moment, of the Biden administration, for all of the president's very hypocritical and disingenuous talk at his recent State of the Union address and otherwise haranguing the oil companies, he brought Janet Yellen in as Treasury Secretary precisely because of her supposed green bona fides, and her and some other people in the administration and positions of power, their game plan to basically use finance to starve the fossil fuel industries into extinction. So that has been the core of the Biden administration's policy for a while, and he's made matters worse by selling some of the oil out of the strategic reserve to try and lessen the damage that his core policies have done, which at best is a band-aid on a gunshot wound, and a gunshot wound inflicted on our economy by the president and these policies. So, inevitably, yes, there is going to be more in the way of investment in these industries. It's not going to be enough. At the same time, we're learning once more with the announcement by Ford in the last couple of days that not nearly enough has been done to intelligently put into places the building blocks for the green economy when it comes to electric vehicles and things like that. I will give the administration some credit for accelerating, and again, not nearly enough, but relative to everything else, one of the better pieces of news, the move away from foreign uranium and to reinvigorate our domestic uranium and nuclear energy industry. But again, when you've had our countries run, and I'll use plural now because the prime minister up there has done much the same thing generally. When you've had countries run by people with these starry-eyed policy objectives and utopian ideas, but who have utterly no understanding of the economic and engineering and physical things that need to be done to get there, this is what we're going to have. And it's why I've been talking since the middle of 2021 that we are in a new energy crisis, which the last few months has only given us a lull in. It will get worse again. We will get back to where we were last year with the oil price again soaring under over $100 a barrel, worries about shortages, worries about trade, worries about who's buying from who and selling to who. And the other one that an abnormally warm winter in much of this hemisphere has given us is that, I wish I had, I say this all the time, Doc Brown's DeLorean, so I can go ahead and figure out the exact day it bottoms. I think we're darn close, but long term, the natural gas price back down to, where it's been at in recent days, $2.50 or something like that after getting near $10 last summer, that's going to go back up because the factors that have brought it back down are going to be fleeting. So, here again, these energy themes across the board are still ripe for investment. And I think the only thing that's going to change that for patient investors that get into the right places and some of the better companies is going to be if we had just a devastating crash that started someplace in global markets that gave us a repeat of 2008. But that would only sharply, perhaps, but relatively briefly interrupt this march higher that we're still going to have for many years to come for almost all of these commodities, all of these new FAANGs themes.
The common theme I'm seeing, at least on the energy thing, is that, governments react, but they do it slowly and late to the party. You mentioned the uranium movements that they're doing, but, they had to cancel or postpone the startup of that reactor in Wyoming because they don't have the ability to enrich the uranium that they need to fuel the reactor. So, that's been delayed for 2 years because government's been slow to the party. So if people are going to be in the Miami area, I guess on the 23rd, 24th, you're speaking first thing on the 23rd. And the two of us will be there. If people see us, they could stop us, pick our brains. This should be short conversations, but you never know. If you catch us at the right moment, our brains might be working. And
hopefully the pickings won't be too slim.
Yeah, exactly. So if you want to register for Mines and Money, you could go to the prospectornews.com website. There's a list of events along the right-hand side of the main page. When you do click in, if you use the promotional code TPN, the initials, the Prospector News 10, the number 10, you'll get 10% off your entrance fee to the event. And Chris, if people want to get a hold of you in the meantime, how would they do so?
Best thing to do is go to nationalinvestor.com. If you've not already done it before, sign up at least for our free newsletter list. I don't, of course, give you all of my recommendations on that because those are reserved for paying members. You can become one of those too on the website. And the clock is ticking down to our new rate structure. So you'll see there that you've still got time over the balance of the month to lock in our present rates for memberships. But even if you don't do that, make sure that you get on my free list and you'll get all kinds of different special issues and thematic pieces and whatnot. And sometimes after the fact, after members get first dibs on them, I do comment on some of our specific recommendations as well. And you'll see some of that too on the front page of the site where I've got a lot of recent commentaries and things.
Looking forward to seeing you next week down in Miami.
Yes.
And we'll have some catching up to do.
Yes, we do. That'll be fun. See you then.
You bet. The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.